Start with energy, explain with authority, highlight with emphasis, and end with warmth. SoundHound AI, trading under the ticker SOUN, is currently at $18.20, reflecting a minor intraday dip of about 0.27%. While this slight downturn might seem trivial, it masks a much more complex and volatile reality for a stock that has seen a nearly 290% surge over the past year. The immediate expectation for many watching this AI darling is a continuation of its meteoric rise, fueled by the broad enthusiasm for artificial intelligence. However, the reality is that the ground beneath SoundHound is shifting, with institutional players making significant moves and the company's own insiders consistently selling off shares. This creates a fascinating tension. Is the retail and analyst optimism warranted, or are the so-called smart money and internal executives signaling a peak? This isn't just about another AI company. It's about interpreting conflicting signals in a hyper-volatile market. Let's start by establishing the common ground, the prevailing narrative that has captivated so many investors, from those using sophisticated platforms like interactive brokers to newcomers on the Robinhood app. The belief is that SoundHound is a key player in the burgeoning voice and conversational AI space, a sector projected to grow to over $20 billion by 2030. With high-profile clients in the automotive and restaurant industries, and a recent accolade from IDC MarketScape naming it a leader in general-purpose conversational AI, the expectation is one of straightforward, explosive growth. Investors see the success of giants like NVIDIA and extrapolate that momentum to smaller, specialized AI firms like SoundHound. The assumption is that its proprietary technology gives it a defensible moat, allowing it to carve out a significant market share. This is the story that has propelled the stock to its current levels, a story that many who are self-investing through platforms like Fidelity or Schwab Intelligent Portfolios have bought into. However, a closer look at the data forces a reevaluation of this straightforward bull case. The reality is far more nuanced. While daily price swings are common, the recent trading volumes for SOUN have been immense, often exceeding the 90-day average. For example, recent sessions have seen volumes of 75 million, 86 million, and even 120 million shares changing hands. This isn't just retail enthusiasm. This is significant institutional activity. And here's the critical insight. While some institutions are increasing their positions, others are heading for the exits. In the most recent quarter, 234 institutional investors added to their holdings, but 141 decreased their positions. More telling are the major moves. Bank of America dramatically increased its stake by nearly 200%, adding over 15 million shares. But at the same time, behemoths like D.E. Shaw, Morgan Stanley, and Point72 Asset Management have aggressively cut their exposure, with Point72 completely liquidating its position. This isn't a unified vote of confidence, it's a battlefield of institutional opinions, creating significant underlying volatility. For the individual investor, perhaps using a service like SoFi Invest for investment help, this divergence among the giants should be a major point of consideration. Furthermore, the insider trading activity presents a stark contrast to the bullish external narrative. Over the past 6 months, there have been 28 open market trades by insiders, and every single one of them was a sale. The CEO, CFO, CO, and CTO have all been consistently selling shares, amounting to millions of dollars. While some selling is expected for compensation and tax purposes, a complete absence of insider buying over a 6-month period of rapid stock appreciation is a signal that cannot be ignored. Those with the most intimate knowledge of the company's prospects are choosing to take profits. This is a critical piece of the reality that often gets lost in the hype-driven expectation of unending growth. It challenges the simple narrative and forces a more critical analysis. Now, let's briefly touch upon what SoundHound AI actually does to ground this analysis. The company specializes in voice artificial intelligence. Its core offering is the Houndify platform, a suite of tools that allows businesses to integrate advanced conversational voice assistants into their products. Think of the voice controls in a car, a drive-through ordering system at a restaurant, or a voice-enabled customer service bot. SoundHound's technology is designed to understand natural human speech, complete with complex queries and context. Its business model is primarily based on licensing this technology to enterprises, generating revenue through subscriptions and usage-based fees. This B2B focus is a key differentiator from consumer-facing voice assistants like Siri or Alexa. They also monetize through their music identification app, but the enterprise licensing is the core driver of their potential. It's a solid business model in a high-growth industry, but the question remains whether its execution and competitive positioning can justify its current market valuation. The macroeconomic environment adds another layer of complexity. While the overall market has been buoyed by optimism around AI, any shifts in inflation, interest rates, or consumer spending can disproportionately affect high-growth, currently unprofitable tech companies like SoundHound. The company is forecast to remain unprofitable for the next 3 years, meaning its valuation is entirely dependent on future growth expectations. If a broader market downturn forces a reevaluation of growth stocks, SOUN could be highly susceptible to a significant correction. The sector-wide momentum that has lifted the stock could just as easily turn into a headwind. Investors using platforms from Fidelity Investments to Interactive Brokers need to be cognizant of these broader pressures. Looking toward the future, the bull and bear cases hinge on a few key catalysts and risks. The primary catalyst is continued adoption of its Houndify platform. New partnerships, especially with major players in the automotive and hospitality sectors, could provide significant revenue growth and validate the company's technological edge. Analysts project revenue growth of over 27% per year, which, if achieved, would be a strong positive signal. The expansion into new markets and the continuous improvement of their AI models are also critical for long-term success. The company has a strong balance sheet with a good cash position relative to its liabilities, which gives it flexibility to invest in growth without relying heavily on debt. However, the risks are substantial. The most significant is the competition. SoundHound is operating in a space with some of the largest and most well-funded companies in the world: Google, Amazon, Apple, and Microsoft. These tech giants have vast resources and can afford to operate their voice AI divisions at a loss to gain market share. While SoundHound's technology may be superior in certain applications, the sheer scale and ecosystem of these competitors present a formidable challenge. Another risk is the company's high valuation. Trading at over 50 times sales, the stock is priced for perfection. Any stumble in execution, slowing growth, or failure to meet lofty analyst expectations could lead to a sharp decline in the stock price. The persistent insider selling, as mentioned before, remains a significant red flag that cannot be easily dismissed. It raises questions about the long-term confidence of the management team. For those considering online investing in SoundHound AI, these risks must be weighed carefully against the potential rewards. So, how many shares of SoundHound AI do you currently hold? Comment below and let us know your perspective on the insider selling. In summary, the story of SoundHound AI is a classic case of expectation versus reality. The expectation narration is of a small, nimble AI company riding the wave of a technological transformation to become a dominant player in the voice AI market. This narrative is supported by impressive revenue growth, strong analyst ratings, and a position as a technology leader. However, the reality is far more complex. The deep divisions in institutional ownership, the relentless insider selling, the intense competition from tech giants, and the sky-high valuation all present significant challenges to the simple bullish thesis. The slight intraday dip is a microcosm of this tension, a reminder that the path forward is unlikely to be a smooth, straight line up. For investors, the key is to look beyond the surface-level hype and understand the deeper currents at play. The real opportunity lies not in chasing the momentum blindly, but in carefully assessing whether the potential for future growth truly outweighs the substantial risks that are clearly visible in the data. The content shared here is for educational purposes only and should not be considered financial advice. Always consult with a qualified financial advisor before making any investment decision.